Hello, everyone, and welcome to the webinar today. We are so thrilled to have you with us. My name is Alexandra Alvarado, and I'm the Director of Marketing and Education here at the American Apartment Owners Association. Today, we have with us Tim Emmanuel from K Properties. Before we begin, I do want to just state a couple of housekeeping items. One is we are recording this full webinar for you, and we will be emailing it to you tomorrow along with Tim's information. And if you have any questions, we will be taking questions at the end of the presentation. So please put your questions in the Q&A box, not the chat. That helps us to better track it. Again, put it in the Q&A box, not the chat, so that we can answer all of your questions, and we will send you that recording tomorrow and the slides. I want to tell you a little bit about our speaker today, Tim. Tim began his career in the U.S. Marine Corps, where he supervised teams of Marines and participated in over 100 patrols and operations during multiple combat deployments, which is amazing. Stateside, he began work in law enforcement, worked the majority of his career as a detective, investigating organized theft, arson, fraud, and crimes against persons before promoting to an administration role. After he retired from law enforcement, Tim was fortunate enough to join the K Properties team, and now he works as a senior K Properties vice president, working with directors, helping clients with their 1031 exchanges into Delaware Statutory Trust investments. And he holds a BA from the University of California, Irvine, UC Irvine, and an MBA from Liberty University. So fantastic. Tim, we are so happy to have you with us. It's your first time speaking to our group, but we are going to be covering a topic we've covered before as far as like 1031 and DSTs, but actually a little different because it's going to be talking about some of those hidden risks, due diligence that we should all be doing for a different strategy, which is related, the 721 UPREIT strategy. So very
Right.
glad to have an expert like you with us on the call. And I'll let you take it away from here if you want to share your screen. Hopefully we can get it in
Yeah.
full screen mode.
Yeah, absolutely. I think we got it all set here. So let
Yeah.
me just, let's see, get
And
that.
everyone, if you could put in the chat where you're coming in from, so you can put in, I'm coming in from Los Angeles, I'm coming in from, wherever it is. I'm going to put mine in there so you all can see it. New York City, Gabby, nice welcome to the webinar. All right. So let's see, can we go any more full screen than this, or is this going to be
Let me
maybe
see.
see the lower right corner, there's the third icon from the top. That might put it in full screen. Yeah, go ahead and click that, or it might already be on that mode.
Zoom page level. I think that's it. Let me see
Full
here.
screen
Oh,
mode.
there it is. I see
There
it
it
right in front of
is.
me. There you go. All
Oh,
right.
wonderful. We found it. Okay, great. Well,
Perfect.
I'll get off camera and let you take it away from here, Tim. Thank you.
Awesome. Thanks so much, Alexandra. I appreciate it. And thanks for the nice intro. And thank you to everybody joining us. We're glad you guys are here. If you're not familiar with K Properties is a national Delaware Statutory Trust investment firm. And a big part of what we do is helping investors who are trying to 1031 or go into some type of passive investment that's not quite as involved as managing your own property. And the DST, the Delaware Statutory Trust, is the vehicle that we prefer to do that through. It's the most effective one. And our space has actually changed quite a bit in the last 20 years since DSTs became a thing back in 2004. And so there's now different investment tools. There's different options that you, as a investor or a potential exchanger, have at your hands. And some of you might have already heard and looked into some different pieces of material on the 721 exchange. And so this presentation is really about just kind of educating not only you folks here listening in today, but we've also been providing this information to our existing clients as they're doing new exchanges continuously to try to bring to light some of the issues and some of the advantages to doing a 721 exchange and some considerations. Now, there's a lot to unpack here, so we've put together a pretty comprehensive slideshow that's going to jump through all the different steps of what a 721 exchange is. And so I'm going to go ahead and jump into it now, and then we'll ask questions and address questions and whatnot towards the end, okay? So let's see here, get started. This is just a little bit about us. We have got to put out our risks and disclosures, obviously. In a nutshell, just keep in mind that you should always consult with a CPA and attorney before you complete a 1031 exchange or a 721 exchange. There's no guarantees with any of these investments. You can lose your money, but there's also a lot of advantages to being able to do a 1031 exchange and go passive. But of course, we're going to discuss and address some of the risks, and this disclosure page does that. And by the way, I'm going to obviously clip through some of this stuff. At the end of this presentation, if you would like me to forward this to you, you'd like a copy of it, just reach out and I'd be happy to get that to you. Okay. So today we're going to be covering some pretty comprehensive, from front to back, how a 721 exchange works. And we're going to dive into what the actual definition is. And then we're going to talk about all the considerations that you should make as you are taking a look to see if this is something that might fit and work in your investment profile. There's our nice, beautiful team there, standing by the ocean out here in Southern California. And again, just kind of going over it. If you're not familiar with who we are a national firm that specializes in these DST transactions. To date, these numbers are a little bit old, but yeah, we've helped a good number of people, almost 10,000 DST exchanges and 721 exchange investments that we've participated in. If you were to tally it up, we're at right about the $40 billion mark now of overall transactions into DSTs. And what does that mean for you? That means that there's a lot of experience here. And it means that if I don't have the answer, somebody close by does. And then you can find out more about what we do for our investors by going to our platform. Our platform has typically 20 to 40 different DSTs, sometimes higher. Right now, we have a pretty good inventory. It's probably closer to 50 from well over 25 different sponsor companies. Not just DSTs and 721 vehicles. We also have private equity investment funds as well, too. Okay, so just to kind of make sure everybody's on the same sheet of music here, we're going to define it. The Section 721 IRS or Internal Revenue Code states, no gain or loss will be recognized when property is contributed to a partnership in exchange for interest in the partnership. Okay, and so what that means is that essentially, if you did a 1031 into a DST, it's a two-step process to completing a 721. Okay. And this slide is going to walk you through that, right? So it starts, the beginning is when you sell your initial piece of property that you are trying to 1031 into something else. All right. So your investor sells that investment with the intention of executing a 1031 exchange. Okay. Everybody tracking? And then the property is exchanged for Delaware Statutory Trust interest. So you 1031 from the property that you own, your investment property, into a DST. All right. And those exchange funds are used to purchase interest in the DST, and then they're held for a period of time. And then a 721 exchange occurs, and the interest in that DST are then contributed over here to on a tax deferred basis to the 721 vehicle's operating partnership in exchange for operating partnership units. So you're essentially moving tax deferred from your property into a DST. And then after a holding period, which is typically going to be a minimum of 2 years, sometimes 3, sometimes 4, you're then going to move via 721 exchange into another, what is typically going to be a REIT. Okay. And now you're going to have shares in that REIT. And that whole process is completed by complete with the benefit of deferring the capital gains on those taxes all the way into the REIT. Okay. And so this structure allows holders of a DST interest to exchange for economic interest in that REIT in the form of operating partnership units. Okay. And so this is another little presentation of how the situation would work. You can see at the top, your property is going to, be essentially you're going into a DST. The DST is then eventually those allocated portions of it are then put into the real estate investment trust, where now once you're inside the real estate investment trust, you have the benefit of a diversified portfolio of all the properties that are inside of that REIT. Okay. So in fact, before we go over to there, I'll say one little thing more about this. So why would somebody want to do this? Well, most of the investors are going to use this as a tool in their portfolio. Okay. And the reason why they would want to do that is because a DST is a very illiquid investment. We do operate a secondary exchange where you can choose and try to have the opportunity to try to sell your DST if you needed to before the holding period, but it's not advised. And so having those shares in a REIT makes sense for investors, especially if they wanted to have a portion of their money available to them liquid. Okay. And so the idea of having that money liquid and having it, somewhat accessible is generally one of the bigger drivers for why somebody would want to do a 721 and be in a real estate investment trust. Okay. The added diversity of the different holdings in there is an extra plus. In certain things, we'll get into some of the risks there that are to be considered. So what we've noticed from an industry standpoint is that we have a lot of investors now that are putting very large amounts of money into vehicles that ultimately are destined for a real estate investment trust, for a REIT. And so when we're looking at this situation and we're looking at how the investors are choosing to allocate those funds, there is some cause for concern. And the cause for concern is that we want to take a look at where and what that money is going, where that money is going to, and what is going to happen to that money while it's in the REIT. Now, if you're familiar with the 1031 process, you know that you can 1031 as long as you want. You can keep kicking that can down the road and 1031 from one property to another property to a DST to endless more DSTs as long as you would like to. We have a lot of investors that do that. The problem is that when you go to a REIT, it's the end game for that 1031 exchange. In fact, once you're in the REIT, when you come out of the REIT, you can't 1031 from a REIT into another property or 1031 from that REIT into another DST. It is the end game for that capital. That capital then, when it comes out of the REIT, if you choose to liquidate and take shares out, you're going to pay tax. There's going to be a taxable event that results. Okay. And so it opens up, a lot of opportunities, obviously, to have the ability to be able to take that money out. But in the same token, there's also problems and considerations that we feel that investors need to really take a look at and consider when they're deciding how much of that money to actually allocate towards living inside of a REIT, which is basically a long-term relationship, since that money can't come out without causing a taxable event. So one of the things that we're gonna do when you work with a Cape Properties a Cape Properties advisor is we're going to be taking a look at a variety of factors that we see that are affecting this money, a lot of which investors are not considering. And so what we've started doing internally here is operating a system where we look at different factors. We're going to go over each one of them right now. And then we provide that information to you so that when you make the decision as to whether or not you want to incorporate this, it's a fully informed decision. Okay, so let's jump into a few of the things that we're paying attention to. First and foremost, one of the things that we see as a risk is fixed versus adjustable rate loans. Okay. So one of the things you have to ask yourself is you need to understand the REIT's debt profile and ask, what is the total burden on the REIT? How much of the debt is fixed versus adjustable? Okay. And if you think about it, think back to like 2008, 2009 timeframe when we saw a lot of the problems that popped up with adjustable rate financing. Okay. Obviously, right now, especially rising interest rates, which are increasing borrowing costs, are having problems for regular everyday Americans and investors that are trying to be active in the real estate market. We can all attest to that. But they're also causing problems for large institutional products in REITs that have got properties that need to be refinanced. Okay. And so one of the things that we're seeing is that, for example, a good amount of debt within these REITs needs to be refinanced. In fact, we actually track that here at K Properties. One of the things that we're doing is we're actually tracking that metric for individual REITs to see how much of their debt needs to be refinanced in what terms. And we're seeing some things right now that are alarming. In fact, a lot of the larger real estate investment trusts are getting on the tail end of their financing, meaning that in the next 24 months, we're seeing ranges of anywhere from 30 to 50% on average of their debt needs to be refinanced. And when you do the math and you think back to the low interest rates that we were experiencing 4 or 5 years prior to this, and now considering where current interest rates are, you can understand why we're paying attention to this and why it's giving us a little bit of reason for concern. And so what happens here? Well, I mean, if a REIT has to refinance a property, or in this case, we're talking, a significant number of their properties, what do you think that's going to do to the payments that REITs make to the investors? Well, if part of their edge was built into the rents, that are coming in, the operating costs and whatnot, and then what's left, they're able to pass on to the investors. If all of a sudden now they're having to allocate more money towards financing loans that have a much higher interest rate, you can quickly see that what's at risk becomes your distribution that's coming off the REIT. So that's one of the things that we're trying to pay attention to now and keep a monitor so that moving forward we can understand and start to see, okay, hey, there's some cracks in this foundation over here. this REIT, REIT A has a significant amount of debt that needs to be refinanced in the next 2 years versus, maybe REIT B or REIT C, which doesn't have as much floating rate debt or has longer terms. Okay. So these are factors to consider. Okay. And so that's one other thing to pick up on. Debt-free versus leveraged REITs. Debt-free REITs are going to carry no financial leverage risk. Leverage REITs are exposed to interest rate volatility and foreclosure risk. So you have to ask yourself, what is your risk tolerance? Can you handle the increased risk from adjustable rate mortgages on your investments? Or would you prefer to focus more on debt-free, lower risk investments? Okay. And so part of our solution, again, is that we are going to be tracking the debt levels that are inside of each of the REITs. And if you're talking to a K Properties investment advisor, you're talking to one of our registered reps here, you're going to be, and you ask them about the 721 process. One of the things that they're going to help you do is evaluate where, if you were to go and do one of these investments, where that money was going to land and what the outlook is of that REIT of where that money would land. Okay. And again, that's going to just help you make a more informed decision. Okay. Another thing that we're also looking at is the dividend coverage and the true yield, which we believe is a critical measure for 721 exchange UPREIT investors. So what is this? And what's the questions that you should be asking yourself? Well, to the same point as from the prior slide, ask yourself, is this REIT's dividend built to last? Okay. And one of the measures that we do that we feel is a real true yield indicator that we feel like has a lot of value is taking a look at the adjusted funds from operations. Okay. This measures if the dividends are funded by real estate earnings or if it's borrowed funds and new investor capital. Okay. An AFFO coverage below 100%, when we're referring to that, or when you see that metric when you're doing your own research, it means the dividends that are being paid out to investors. Is that relying on new debt, on debt or new investor capital? How is that being provided? It's a red flag for us when we're taking a look at these things when the AFFO coverage is below and it's not, they're relying on new investor capital being put into the REIT to be able to make the payments to the existing investors that are already in there. Okay. So that's a metric also that we are following closely, not only on the large REITs, but also on, the small and the medium sized ones too. The REITs paying, sorry, I'll go to the next section here. When REITs are paying an unsustainable and inflated dividends, it's masking the actual financial stability of the REIT. Okay. And so if you think about it like this, a lot of times REITs are raising a good amount of capital, not only through the 721 process with new funds coming in, but when real estate markets slow down and exchanges are not happening as frequently, that new money that's coming into the REIT to help support, all the operations from the REIT, the dividend payments to the investors and whatnot, that slows down too. And so if they raise a whole bunch of money like they did back in 2020, 2021, 2022, when the market was, really going gangbusters, and then it slows down significantly, like what we've seen in the last 24 months, especially, when now we're taking a look at the numbers and we're saying, hey, wait a second, they're still paying out, significant amounts of dividends, but there's not a lot of new capital coming in. How are they able to sustain that? And as a very large REIT, they should be able to sustain that for a certain period of time. However, if things don't correct, then it stands to reason that eventually they're going to probably have to lower those distributions, those dividend payments to the investors in order to keep the ship righted. Okay. And so what are we doing here? We're tracking which 721 UPREIT sponsors are covering their investor dividends from the adjusted funds from operations. And then we're also taking a look and tracking at the ones that are not. And again, by providing you this information and looking at this information ahead of time, most of the REITs are reporting on like a quarterly basis. And so we're able to then update that information as it becomes available, provide this to the investors, and then you have the ability to then make a much more well-rounded decision on how you want to see your proceeds invested. Okay. So this slide is kind of a neat demonstration here, and it basically is going to break down what I was just mentioning about the inflows and the outflows. Okay. And so we have a very simplistic representation here where we show that a REIT raises $50 million, but they see $200 million in withdrawals. And by the way, when we're talking about withdrawals, one of the things that we're referring to is the fact that within REITs, you have the ability as the investor to go to the REIT, maybe on an annually basis or a quarterly basis, depending what the terms are, and request redemptions. Okay. And so that's you going to the REIT and saying, hey, I have $1 million investment that's been allocated here. I would like to take $250,000 out. So that's the scenario that we're discussing. Okay. So large net outflows can signal liquidity challenges and can be a risk to investors. And you can think of it like this. In a situation where, you're not the only one going to the REIT. Let's say, the REIT plans to have, 1% or 2% of their capital redeemed and given back to investors based on investors, normal withdrawal habits. But then let's say, we hit an economic patch where times are tight. And a lot of these investors are now going to the REIT and saying, hey, I need that money for living expenses, or I have an unexpected, expense that I want to account for, and I want to use this money. Well, if we start having a lot of folks all requesting money at the same time, that net outflow becomes a real problem because, as the slide is demonstrating, the REIT has perhaps not been able to raise that much money. And to go back to my earlier example, we saw large inflows in 2020 through 2022. Those have tapered down. And so now with the inflows not coming in, you have to ask yourself, how is the REIT able to provide liquidity? And so what are we going to do at K Properties? We're going to take a look at it because certain REITs are positioned better than others, and certain investments that are going into those REITs might make more sense. They might have the ability to, be able to maximize what's going on, to be able to make sure that they're able to meet investor demands, not only now, but in the future. And we can take a look at those metrics and relay that information to you. Another area that is definitely worth mentioning, and we're talking about on this side, is the presence within the private placement memorandums of markups and fees. Okay. So if you've looked at a DST and you've ever gone through a private placement memorandum, you know that those books can be very large. I mean, we're talking like anywhere from 150 to 300-page documents sometimes. I've seen them bigger. I've seen one just recently that was close to 500. Massive amount of information. A lot of it is boilerplate, general risk disclosures that everybody should be aware of when they're investing. But also what we're seeing is, hidden fees and markups that are not necessarily as obvious to the investor. So what does K Properties do? We review those, and we're going to bring those to your attention when we find them. Inside the private placement memorandum is generally all of them are going to be titled the same. You're going to be looking for a chapter that's called the estimated use of proceeds. Okay. And the estimated use of proceeds is going to be a line by line breakdown of where the sponsor company is spending money to not only syndicate and operate that DST, but then put it in front of you. Marketing, commissions, fees, reserve pools for how much they're going to need for future repairs and whatnot. All that's going to be laid out. Okay. And so it's a big document, but that page in particular lays out all those fees. Well, it's not always obvious, but what we are seeing in certain times in certain DSTs that are doing the 721 process, especially, we're seeing other fees and other expenses that are throughout the PPM, not necessarily super obvious in the estimated use of proceeds section. And so why is that important? Well, we have a lot of investors that we're seeing that have gone into some of these investments, and they're assuming that there's minimal fees, but they haven't really had the transparency, opened up to them to see that there's other fees and there's other expenses that are built in. And so what happens? Well, this leads to the potential for misaligned expectations and an increased financial risk. So what should you do? Because that document's big and it's not the easiest thing to just flip through and look through and, figure it out for yourself. It does take time to understand how to read those. What I would suggest is work with a team that specializes in taking a look at these things and breaks them down. Private placements are inherently complicated. And we're just talking about real estate private placements now. I'm not referring to, other development projects and all types of alternative funds and investments that are very prevalent in the market right now. But specifically with private placements, it's important to speak with an expert. Okay. And I know, in my intro a long time ago, they mentioned I was in the military, in a career in law enforcement too. And I'm grateful for my time, but unfortunately, one of the casualties there is, your body takes a beating when you're in that type of service. So to date, personal information, I've had probably close to, I'm just shy of a dozen orthopedic surgeries at this point for various injuries that I had overseas, as well as my career here. What I've learned through that process is that it's important to go to a specialist. Okay. I would certainly not go to, my general practitioner to get a knee surgery or a shoulder surgery. I would go to a specialist. In fact, knowing what I know now, I would go if I needed a knee surgery or shoulder, I would go strictly to a guy that specializes in those operations. And the reason why that matters is because that experience and that insight that he's going to bring is going to mean a couple things. One, my healing process is probably going to be easier. Two, my likelihood of, having a problem with the same area is going to be minimized. And three, he's generally going to be on top of current trends in that field. Okay. I mean, I'm not saying that what we're doing here is as complicated as a knee surgery or a shoulder surgery, but take a look at the 200 to 300 page PPM and you'll understand what I'm saying. Like there's a lot there. There's a lot of material risks that you need to be aware of. Working with a specialist in the field is absolutely crucial. And so what are we doing here to help, with our investors? Well, specifically, we are tracking which 721 UPREIT sponsors are doing things like hiding unnecessary fees or just fees that aren't very obvious. Maybe they are necessary, but we're going to find those and we're going to point them out to you. And we're going to show you exactly like what that means for your overall return is best to our ability. Okay. And so this is going to, again, be one more thing and one more benefit that's going to help you hopefully make a more informed decision and to ultimately protect your hard-earned money. Okay, so here I'm gonna dive into a little bit more to the valuation and the markups that are related with some of these 721 transactions. Okay, so it's important to ask the right question, and one of which is this an affiliated transaction whereby the REIT already owned the property and is not selling it to the DST investors, i.e., a non-arm's length transaction? So this is a potential red flag as it can signal a hidden markup. Okay, arm's length unaffiliated acquisitions are preferable and provide more transparency to investors. That's that first paragraph there, and I think it's important to emphasize that. What is this referring to? So basically, it's common practice, and it's something that you should, as the investor, should be aware of up front. But a lot of times, the REIT can drop a property down, package it into a DST, and then offer it to investors, right? This is something that they can do. It helps them raise capital on hopefully good properties that they're putting out in front, good properties that have been well maintained and are operating well. Well, the problem is when they drop that property down and they offer it to investors, if we start seeing a markup on that property, whereas the fair market value has been inflated or has maybe been, adjusted unaccordingly, that goes against the actual valuations for what's happening in that asset class on a commercial level, when we see that change in price, we're going to take a look at it. Okay. And what does that signal? Well, it can signal that there is some type of hidden markup because of the way that they're inflating the price and then offering that to the investors. Sometimes REITs and financial advisors might claim, and oftentimes the financial advisors don't, they're not intending to mislead anybody, but they might say, hey, there's no or there's minimal fees. But quietly in the background, the property that is now being offered as a DST or as part of this transaction has been marked up. And this this can obviously increase the risk that perhaps this property's return is not as strong as you intended it to be. So a hidden markup can signal overvalued assets and hidden fees, which obviously, like if they've paid too much for a property because of one of these markups, what's going to happen? Well, your potential return is going to be reduced. Okay. So it's important to compare the property's prior valuation versus its 721 UPREIT DST sale price. And that's where you're going to be able to see that discrepancy and make a better decision at that point as to whether or not this property has been unfairly marked up. And so there's a good example on the right-hand side of the slide here. It talks about a property values at $100 million. And then the UPREIT price, it's getting marked up to $120 million, a 20% markup. And we've seen this happen relatively recently in the market. So it is happening. It is occurring. And while on one side of the coin, you might have a sponsor company or, somebody claiming that, hey, like, this particular offering doesn't have any sales commissions or fees or anything else built into it. But when we look at the actual valuation history on it and the price of the property has been marked up significantly, that in itself is a hidden fee. And it's something that you as the investor should be aware of because, again, it does affect your bottom line of how that property is going to perform. Okay. The next thing I want to jump into are tax protection agreements. This is a very this is a subject that has not really gotten much press. In fact, I don't think a lot of the things that we're talking about today has gotten a lot of it hasn't been really highlighted the way it needs to be. But this in particular, the TPAs are something to be aware of. And so basically, what is a TPA? It's a contract where the REIT agrees to indemnify investor tax liability if a contributed property is sold without a 1031 exchange. So the risk here is that a property that's inside of a real estate investment trust gets sold, and when it's sold, the investor, because you're involved in this REIT, has an unexpected tax bill that comes looming, that comes after you. Okay. If the REIT sells this property prematurely and doesn't complete a 1031, that's where you could potentially at the end of the year find out that you've got a tax bill you were not expecting. So what do? We track which 721 UPREIT sponsors offer tax protection agreements and their terms. And so the problem here is that many of those tax protection agreements are going to run 2 to 5 years. We don't see a lot going beyond that. But what we're now, after we're starting to point this out, we're starting to try to, let the industry know and let investors know that this is something that we should all be considering and thinking about. We're hoping that it becomes more well known and more, examined from these days forward. But traditionally, what we're seeing in many of these offerings is either no tax protection agreement, meaning that a property gets sold within the REIT, and then you, as the REIT operating partnership unit holder, then incur a unexpected tax bill. Or two, we're seeing short-term TPAs that are in place, which means that if that occurs in the first 2 to 5 years that you're inside of that REIT, that it is then going to be covered and taken care of by the sponsor company, so you don't have to worry about it. But you're on your own after that. Okay. Now, some people might look at this, and I've heard even some sponsor companies say, well, hey, 2 to 5 years is more than enough because most people are going to be, liquidating or taking their money out of the REIT. But wait a second, what happens if liquidations get shut down because they don't have the liquidity to build a fund investor redemption request? Or what happens if too many investors ask for their money out and then they have to shut it down, right? Or you get to a point where maybe that allocated money that you put into this investment, maybe you thought you were going to need the money and you were going to try to take the money out 3 to 5 years down the road, but 3 to 5 years down the road, your financial picture changed. You didn't really need to get that money out because you realized that the tax implication for any withdrawal out of there was going to be so large, it really didn't justify pulling the money out. So now you're in this long-term marriage to a real estate investment trust with nowhere to go that doesn't cause anything but a tax liability when you do cash out. And then, as if all that wasn't enough, you've also got the fact that the REIT occasionally is going to be selling properties, which is going to automatically trigger tax issues for yourself. Okay, so important things to consider. And again, the last thing I want to do is say that these 721s and these REITs don't fit and they're all full of problems and they just don't work. Okay, that's not the case. It is a very useful tool to have in the toolbox, especially if you have a potential need for liquidity. But these are things and these are factors that we don't hear enough folks talking about. And before you allocate money to this, before you complete a very large 1031 exchange, whether that's $500,000 or $5 million, before you take whatever your chunk of change is and do a 1031 with the fact that you're going to put all this money into a 721, consider these options and consider the fact that your timeline could change, the REIT's timeline could change, and ultimately, if you're in this, the only way out is going to cause some types of tax issue. So things to consider here. Okay. One of the last things that is one of the sticking points too, and for some people, it might be the bigger piece of all of this is optionality. Okay. When you look at 721 exchanges or DSTs that are going to potentially be targeted by REITs for UPREIT, the word optionality is taking on we're bringing more attention to that word and we're bringing more attention to what that means. Here's why. Optionality is critical for you to consider. So basically, what this means is that if you have the right to optionality with a DST, that means that when it comes time to 721, you have the choice. Do I want to participate in this now or do I not? Okay. Now, there are other 721s, which are really useful for investors that are very certain that they need liquidity within a certain time period. And it's called a forced UPREIT. Okay. And a forced UPREIT means no matter what, let's call it 2 3 years down the road, this money is being via 721 UPREITed into a real estate investment trust. Okay. And again, that is a useful tool for the right investor because maybe they have that expense. Maybe, their daughter's getting married or they want to help their kids out with down payments on homes 5 years from now. Or maybe that college bill is going to be coming up and that large expense is going to be allocated with this money and it's going to be taken and covered with this money. Then yes, the forced upreit might be a great tool for you to do on that part of your exchange. But if liquidity is, kind of got your attention, but you're not really sure what it's for, consider optionality. And what optionality is going to do is it's going to give you the option to, at that point, make the decision as to whether or not you want to be able to go ahead and go through with that transaction or not. It gives you control over your tax deferred status. Okay. Whereas forced conversion is the potential loss of control, liquidity issues, the unknown risks that come with being in a REIT long term, if you're going to end up there long term. The optionality allows you a second chance to evaluate, do I want to consider, or do I want to consider this further and do this? I think before we get into that slide, I'll say this about how K Properties helps out. So let's say you do go into a DST or you're considering a 1031, doing a DST, and you want to take a look at whether a 721 might be right. Well, at the time of K Properties building your actual portfolio out of how you're going to do your investment, we're looking at where this money is going to go to. We're looking at what that REIT looks like, and it might look great. Like everything might look stable. The financial picture looks solid. We're good. But 3, 4, 5 years down the road, your timeline changes, the REIT's performance changes, the economic situation changes. Okay. K Properties isn't just done at the beginning. We're still here. And so how is this process going to work and what are we going to do? Well, we're going to say, hey, John, let's take a look. 3 years ago, this looked like it might be a good option. Luckily, you picked optionality. Let's see if this is still something you want to pursue. And at that point, we're going to then review the current metrics on that REIT and determine, hey, do you need to go have a conversation with your CPA and see if this and verify, but maybe this doesn't look as good as it did 3 to 4 years ago. Or maybe it looks better. Maybe the REIT is more liquid. They've brought more money in. They've increased distributions, and this turned out to be a great move for you. Rather than gamble, optionality gives you the ability to have a second at bat a couple years down the road and evaluate, with your advisors, is this still going to be a good fit? So one of the things I wanted to throw out there, how important optionality is, and again, something that we're trying to bring what we feel is a critical eye on this very, very important topic. Okay, so we're going to go over this slide here, which is basically how a 4721 UPREIT can go wrong. And again, unfortunately, we do have current examples of this that have happened. It's a Google away. You can check it out and you can do your own research. We're happy to help you out too, of the danger side. And again, not trying to say that this is always going to happen, not trying to say that, this is a bad option for everybody. Just trying to say that if you're looking at the 721, here's the bad side of what can happen. Let's plan, let's diversify, let's build your portfolio, let's build your investment for the ability to be able to pivot to new trends and to stay, and to stabilize versus going all in on something that could potentially change your economic situation that you're in. Okay. So what is a 721 UPREIT going wrong? Well, so let's just use the examples we talked about, right? First and foremost, the REIT takes on large amounts of floating rate debt. Okay. Adjustable rate mortgages. Okay. Interest rates rise, debt becomes unsustainable. Sounds a little familiar, right? I mean, this is what we started off with. This is what's going on actively right now. Distributions potentially will be reduced or eliminated altogether. What happens? Well, those interest rates rose. The debt had to be refinanced. Now it's at a higher rate. On top of that, we've got folks trying to take money out. So what's going to happen? Well, at some point, the REIT has to tap out if they can't meet the investor redemption requests. Or they either have to say, hey, we're not doing any more redemption requests for this period of time, indefinitely, we're cutting distributions, or all of it. Okay. And then what happens for you? You're stuck with an investment that potentially has no exit. Okay. And so we don't bring this up to really, drive home being fearful. We bring this up because these are active events that are happening. You can Google it yourself and find what's going on. But these are, situations that we have present investors that are in, that have come to us from, other investments from other folks, and they're seeing what's occurred. And this is something that we say, hey, look, we're not saying that we can guarantee this won't happen to you in this investment. We're just saying that there's a better way to investigate understand the risk, and then reallocate or allocate your current investment to hedge off and protect you from these types of events happening. Okay. And so again, just to kind of summarize our position on this, we feel that rigorous 721 UPREIT is and due diligence is very necessary. Okay, we think it's essential. The 721 UPREIT is not a one-size-fits-all investment. As we've covered, there are many unique risks. Unfortunately, we have many financial advisors and wealth managers recommending, investors put an entire 1031 exchange into a single 721 UPREIT DST. And, kind of to my point before about finding a specialist, financial advisors and wealth managers have to know a lot about a lot of things. And the 1031 space, the DST, the 721 space is extremely specialized. And so, they might, we have a lot of financial advisors too that work with other groups that will advise on these, but they may only have, 2 or 3 options for DSTs for their investors to go into. And as I mentioned earlier in the presentation, the DST has only been around since 2004. But we have seen this space change drastically in the last 20 years. We've got, varieties of business plans. We have all types of different investments that have varieties of timelines by which they execute that. Don't go into a one-size-fits-all investment just because it's being offered, by somebody that, like a financial advisor or wealth manager that you trust. Do your own due diligence. Research what they're telling you. Research what the end result is for that money. But don't skip the due diligence because it's very important to understand that like all these things can pile up. And it is actively happening where investors are biting off more than they can chew and realizing that, this could have been better allocated or better managed up front. Okay. So again, we encourage you look beyond, wealth manager and investment advisor relationships, and then actually analyze the REIT financials before you take a look at these things. What are we doing? Well, we are a specialist in this field. We actually have teams of analysts that are tracking these numbers presently, that are looking at the metrics from all different angles. And we're doing this on a quarterly, not only, monthly basis, but quarterly. We are updating our own internal review to be able to include updated information from all the major REITs, as well as a lot of the smaller ones that we're actively involved with, to check and make sure that this is still going to be a safe destination for our investors. And again, it's certainly, our due diligence is certainly not going to be a guarantee that ours are going to necessarily work out or that our advisement is going to be correct, right? Because there's so many factors at play here. However, doing some sort of due diligence and being as thorough about it as we possibly can, based off of what we're seeing in the marketplace now and past experience, is going to be critical to making sure you're in the best place years down the road when these decisions start to really affect your economic bottom line. Okay, so and I think this is basically the end of where I'm at here, Alexandra. I'm going to wrap up the last part. So, and again, just to kind of review why we stand out. KPI 1031 marketplace, where we feature all of our DST products and our 721 products. So if you log in and you check out the actual back end of our website, you'll see our current inventory page where our analysts have actually gone through all the different offerings that we have. And when, something stands out that's a flag that you should be aware of, you'll see it marked on there, risk awareness, heightened risk awareness. They're going to drop down and talk to you about, little things that are, maybe in the loan terms or the lease terms or things that you should be aware of. And so how do we stand out? Yeah, we provide transparency. We have data-driven insights. We have the ability to really take a look at these offerings and then, because this is all we do, and see, the abnormalities when they step out. And then on top of that, because of the amount of volume that we do and our relationship with the sponsor companies, we also have the ability to do a lot of these transactions for significantly lower fees than a lot of the other competitors that we have. And that's just because of our presence in the space. So again, yeah, the KPI 1031 website there, that's a good sample on the right-hand side. You can kind of get the idea of what it looks like on your computer and also when you're using our mobile platform. But again, it's driven, to provide the information that you as investors would generally want. I think that's about it. Yeah. All right, Alexandra, there we go.
Okay. Wonderful. Well, thank you for going through all of that. I do have a poll question for everyone here on the call before we jump into Q&A.
Sure.
Would you like a complimentary consultation to learn if a 1031 or DST or this 721 strategy is right for you? So if you want, you could say yes there. I'll be sure to connect you with someone from the K Properties team after this, so we'll prioritize that. And while you're putting that response in, I'm going to go ahead and look through some of the questions and throw them out at you, Tim.
Sure.
John is asking, so can I defer into multiple DSTs or are we limited everything to one DST?
No, that's a great question. Yeah, that's one of the advantages with the DST is you don't have to just pick one. If it's a a $200,000 investment, we have investors that'll choose to allocate different portions, and you might put it into three or four and divide it how after talking to your advisor and whatnot, divide it as you guys see fit based on your risk tolerance. But yeah, we can absolutely divide into as many as you like to go into.
So I think you covered this already, but it'd be good to do a summary here for Tom. How do we mitigate our risks when doing an exchange and then DST to 721? How do we make money and not lose money?
No, that's great. That's objective number one, right? Is like let's try to protect the principal. Let's keep the income coming in. The answer there, diversification. And that's one of the things that I do like about the DSTs as opposed to, just owning a single rental property, right? Like with one rental property, let's say you only own one or two rental properties, a lot of your money or equity is trapped into one of those properties, right? Or two of those properties. But one of the advantages of the DST is, you can diversify into different asset classes, geographic locations, into different trends that are being identified as having, good growth prospects. And then because of that, if let's say an unforeseen issue happens, like I think a perfect example would be like COVID, right? Like COVID happened and we saw a hit in student housing. We saw a hit in senior living, right? Senior living took a big hit during COVID with, a lot of our that generation, having to deal with all the litigious nature of what was going on with the nursing homes. Well, those issues were not necessarily known in 2018, 2019. Up until that point, those were great investments, right? And storage, which had been relatively, kind of boring, for a long time, all of a sudden, with everybody moving in 2020, became a huge opportunity to be involved in. And so by diversifying, we can then take away, some of that risk, not necessarily, prevent it from affecting you, but limit its impact on your volatility on your portfolio.
That's great advice. Rick asking here, but if let's say you are selling a property that is leveraged, don't you have to invest in a DST that also meets those leverage requirements?
Right. And to go back to the earlier question about diversification and going into multiple properties, that's one of the nice things that DSTs can do as well. So I'll give you a quick example. So let's say you've got a property that's $1 million property and you've got a $300,000 loan that's on it. Okay. So roughly a 30% loan to value. Okay. What we can do in that situation is we can use a DST with, let's say, a 50% or a 60%, average loan to value to be able to handle the debt portion of that exchange. Okay. And that frees up the rest of your equity. So if you wanted to go into something that did not have foreclosure risk, like a debt-free DST, you could then do that. And so by using two properties, one to handle the debt, one to handle the remaining equity that you had left over, you could then diversify and be able to satisfy that IRS requirement of the overall exchange price.
Beautiful. Well, I'm sure your team could probably consult, depending on what your portfolio looks like and your debt on your current properties. John asking here, if my risk tolerance changes, say in a few years, can one move from a leveraged to a non-leveraged REIT?
That's a great question. Once you're in the REIT, you're generally stuck in the REIT. Now, there are times where REITs will buy others, okay, and like take those other REITs into their properties. And if that was to happen, it's a rare occurrence. I believe there's a mechanism for that to happen. But once you end up in the REIT, most people's experience, most investors' experience is that's where you're going to stay. And the reason being is that that is the end game for that money. And if you had the ability to take it out and try to go to something that was different, it's not like a stock. It would trigger some type of tax consequence in that space where it probably wouldn't be worth it necessarily to do it. But again, that would be a very rare occurrence when you'd have the ability to be able to actually take the money out and make that work on paper.
Yeah. Tom asking, what's your success rate in placing clients like us in 721 sponsors? How many have tracked successfully through completion without failing or causing a taxable event prematurely or the client losing cash?
Um, That's okay. So I'm interested in the background on that question. So K Properties, we have relationships with all these different sponsor companies, some of which have already got their own REIT already established. Okay.
Mhm.
And so when you're doing a forced up REIT, generally you know that unless something terrible was to happen, the sponsor on that particular deal is going to make sure that those investors end up in that REIT. Okay. Now, the sponsor company wants, if this is a forced REIT, UPREIT transaction, they want that transaction to occur because they want the extra liquidity that your investment is bringing to that REIT. Okay. So absent some terrible, occurrence, they're generally going to want that money in there. So when it comes to the overall success rate of that transaction actually going through, I would say it's very high. I don't know off the top of my head exactly what it would be, but I would say that most of the UPREITs that I've been involved with, that we've worked with here, if they say it's a forced UPREIT, generally within the 2 to 3, maybe the 4 year mark, that UPREIT transaction is happening. Those people are absolutely going into that REIT and they're getting, the benefits of why they went there, the extra diversification, the potential for liquidity, and then obviously the monthly distributions or quarterly distributions that continue to.
Okay, good explanation there, Tom. Asking also, can we control or limit or contract the amount of outflows for the REIT?
Yes. So generally they're going to cap that. It's I've seen it as low as 1% annually. I've seen it as high as 5, 6% annually. But they have the ability to be able to change that. And they don't have to give a timeline of when they're going to change it. They can be honoring it today and then tomorrow be beyond their limit or economic conditions change and they can axe it right there and be done.
Great. Lucia or Lucia, not sure how to pronounce. If the DST is debt-free, does the UPREIT have to stay debt-free?
No, and that is what it becomes kind of a kicker for a lot of people too. We didn't actually cover that on the slides. That's a
Hmm.
great point that she just brought up. So a lot of our investors are debt free, or they've paid their loans down to the point where the loan to value is very low, 20% or less, right? So they're what we would consider a very safe position to be in, right? Well, most of these REITs have the ability to fluctuate their debt. So they can take on up to 65, 70% loan to value ratios if they need to. Okay. And so if you're the investor, this is another thing. And also, we probably should just add this to the slide because I think that's a great point that she just brought up. Because you can be a debt-free investor, right? And you have no foreclosure risk whatsoever. But as soon as you go to that REIT, now there's a loan to value on all those properties. So now you have an inherent loan to value risk, right? And so, yes, that's a great point to bring up. It is a major risk. It's something that I don't think enough people talk about. And unfortunately, if you've, done everything right for all those years, you paid that loan down, you were debt free, you had the benefits of that, and then to allocate a large chunk of your exchange to something that ultimately is going to have a pretty significant loan to value exposure to it, that is worth considering and thinking about and talking about. Sadly, I had a guy on Tuesday actually. I had called in. I won't drop the name of the sponsor company. Everybody would recognize it. Big financial institution. $3 million exchange, totally debt free. He had owned this. It was like a fourplex out in Denver. He'd owned it for a significant amount of time, and did an UPREIT transaction through his financial advisor, all in one DST, a debt-free DST that was destined for a very large REIT. And then 3 years after the whole exchange happened, realize the gravity of what had just occurred and the tax consequence of actually getting all that money out in that one step now that it was there for the long term. So yeah, these are things to think about. And again, I'm not saying it's a terrible idea. If you have a liquidity need, if you have a budgetary item, if you have, a goal in stone that is going to happen, the 4721 is a great idea. Like it's a huge tool for you. You should utilize it. But if it's something that is just, the liquidity idea is interesting to you, you're not quite sure, under allocate before you over allocate, I think would be the safest way to play that.
Hmm. Good advice. Tom asking, are you folks fiduciaries?
We have Reg B, which is like a similar type of situation where basically what that means is With our licensing, we have to act in the best interest of what is good for you as the investor, meaning that we want to know about your financial profile. We want to know what your exposure to real estate is. We want to understand that, you've taken all the necessary steps to talk with a tax attorney, to talk with your CPA before you make this investment. And then we're going to help base and build our portfolio off of those information items to make sure that you are in something that matches up to all those goals and all those needs that you have. So we are not technically under the registered fiduciary responsibility. All of us, based on our licensing, most of us have a Series 22 or Series 7. So like for myself, I'm a stockbroker Series 7. Others have private placement Series 22 certifications. And as part of that, if you were to read the material and read what we're required to, how we're supposed to base our decisions for investors, very, very similar, but it is different.
Good. Okay. Thanks for clarifying. Nanette asking, came in late, but can you invest in DSTs without doing a 1031 or having a prior investment?
Yeah, you can. And a significant amount of our business is cash investors that just are not happy with what they're seeing in the real estate market, and they have cash or capital they want to put to work.
Mhm.
And maybe in their local area, to get into the real estate market, they feel like they need a $500,000, duplex or $500,000 single family home to rent. They don't see it, but they want to put the capital to work. Yeah, we can do direct cash investments into DSTs. Just like any other piece of property, same rights. You get the depreciation, you get the stability of the passive investment income. Yeah, so it's definitely a significant part of our business.
Great. Dina says, what are the typical fees involved and how are they paid?
Yeah, so the fees with DSTs are all part of the syndication process. Most of the fees to assemble and put these deals together are all going to be revealed in that slide I talked about, the estimated use of proceeds section. I would say, on average, to syndicate a deal and put it in front of the investors, they're going to lay out the organization costs, they're going to lay out all the registration fees, the cost of ongoing maintenance, all that stuff is disclosed ahead of time, packaged into the DST, and then offered to the investors. It's a one and done as far as like K Properties is concerned. So like we get paid by the sponsor companies up front ahead of time. You're not issuing a separate check beyond your investment, and there's no capital call or recurring fees that we're charging either. The only difference I would say, you can buy DSTs with you can buy it through your financial advisor. The difference with K Properties is that we don't charge an assets under management fee or an annual recurring fee. Again, 5 years down the road, let's say you wanted advice on how to manage or handle your DSTs. We're not having you write another check for that either. If we follow the investment. So if you're in one of our investments and you call up 5 years later and say, hey, I have another exchange or I have another 721 I'm considering, then we're going to pull the numbers, pull the metrics, give you the information, and work with you to figure out what's best. But yeah, our fees on the front end by the sponsor company, that's how we get paid.
Beautiful. Okay. John asking, on a forced up REIT, can I pick the REIT or is it fixed?
It's fixed. Yeah, you'll know ahead of time what you're going into.
Good. Rose asked, how long is the typical holding period in an up REIT and how is the value of my shares valued if I want my cash out?
Great question. So the holding period for most UPREITs they're gonna keep it on the slimmer side. It's going to be 2 to 3 years, and they're going to try to start that UPREIT process. Those shares are going to be based upon the net asset value of that REIT at the time of UPREIT. That's typically the way it's going to be done.
All right. Lucia or Lucia asking again, can you take money from an IRA to invest in a DST without tax consequences?
Okay, so I think I understand what you're saying. So basically, when you can invest in a DST or in some other funds that we have within your IRA, like you can use that as your umbrella to be able to do the investment. But to take money out of the IRA and then invest it into a DST, no, like there would be a tax consequence or some other type of penalty depending on your withdrawal, from the way I understand it.
Hmm. Lawrence asking, do 1031 deals do cost segregation?
Yeah, most of the time you're going to see that on multifamily DSTs. That's where that's going to typically come up and happen. Not all of the sponsor companies do that. We do track which ones do and which ones don't. But I would say by and large, probably 75% of them that are doing multifamily do.
Great. Okay. Well, that concludes our questions that we had today. We're just
All
a few
right.
minutes over time. Thank you for answering so many questions before we
Yeah.
ended. And also, just want to remind everyone, I am recording this. I'm going to email everyone the recording and the information for K Properties. If you did say yes to the poll question, you're going to get contacted by someone on the K team. And then also, if you said yes to the registration question for your DST toolkit, that'll be coming soon as well. Tom says, thank you guys. Great presentation. Thank you, Tim and Alexandra. Oh, you're welcome. So glad you all learned
Tom.
something. I certainly learned something. I think it's great to know about all these hidden risks. It sounds great on paper, but we really need to be aware. And you all do a really great job of educating people on that. So thank you.
Awesome. Thank you. Thanks for having me. It was great.
All right, everyone. Have a wonderful day. Take care. Bye.